Uh, Hi, good evening, everyone. Welcome to Ab India Karega Invest, our weekly initiative to reach out to all of you. And we come out with an interesting topic every week. So today's topic is investing in multi-caps. So to discuss on that, we have Mr. Anupam Tiwari from Access Mutual Fund. He's the equity fund manager. A hearty welcome to you, sir.
Thank you, Karthik.
So the flow of the event is going to be, I will start the session, we'll set a brief background about, what multi-caps are and why multi-caps. But we would love to hear more from Mr. Anupam. And then subsequently, after Anupam's speech, we'll take up the questions. So please post all the possible questions. We would love to answer as many questions as possible. Okay. Let me just share the screen in the meantime. Is the screen visible, Anupam? So to talk about multi-cap funds, right? I think one of the oldest variety or the category of funds what mutual fund industry has seen is large cap funds and diversified equity funds. In 2018, when mutual fund schemes were recategorized by SEBI, those schemes were called as the diversified equity funds were called as multi-cap funds. And then subsequently, SEBI came back with a new definition for multi-cap. Then subsequently, the older funds, most of them decided to remain as Flexicap funds. So sort of all the older funds, what you see today, the so-called equity funds or diversified equity funds, they are Flexicap funds now. So then what is this new multi-cap as a category? And why is it important for us to understand multi-cap as a category? And then why should you have this in your portfolio? Is what we are going to look at from today's session. I'm Karthik, so I'm going to take you through the program on this. So talking about large, mid, small as a category, right? Large cap is generally considered as the boring of the lot, whereas small cap is the one which gives us the excitement about investing, especially with reference to last 1 year's performance. Not just been double-digit return, small cap has almost delivered triple-digit returns. Imagine money doubling in a year's time; it's phenomenal. So everyone would want to be part of the small cap. But at the same time, small cap as a category or a mid cap as a category has its own downside as well, right? Large cap is boring, but returns are less. But at the same time, the upside for having large cap in your portfolio is it brings consistency to the portfolio, reduces the overall portfolio risk. Okay. So how is that possible? If you just look at the year-on-year performance of large cap, mid cap, and small cap, that is at the BSE level, BSE Sensex, BSE mid cap, and BSE small cap. Year on year, what has been the returns generated and how much volatility each of the category carry. The pink side of the graph, what you see is actually large cap. If you see, that's the most consistent part of the returns, and what you see as dark grayish, that is small cap, that carries the riskiest segment. When we say risk, volatility, it could be extreme in terms of positive returns, or it could be extreme in the side of negative returns as well. Look at 2008, the losses were far higher compared to large cap and mid cap. So then in that case, many people would say that, okay, someone who says, I don't want to take risk at all, will it make sense to be part of large cap only? If small cap carries such high risk, let me be part of large cap and mid cap only. So if you look at year-on-year performance of these three categories, there is no clear winner. Not even a consistently saying that, okay, every year large cap is really outperforming other. That's not the case. There are years small cap is really outperforming large cap and vice versa. But which are those years? Especially when you see a great market recovery, a year of a great bull run, you would see small cap outperforming large cap. But at the same time, during market crash kind of events, it is always large caps which have really outperformed the small cap. So the big question in our mind is, what should you be doing? Should you be investing in large cap or mid cap or small cap? What should you be doing? Or is there a way where we can mix all these three and put it in a portfolio? That is exactly what a multi-cap fund would be. Under the new recategorization rule norm, which is introduced by SEBI, the categorization is the portfolio composition is very simple. Large cap, mid cap, and small cap, each of them must have minimum 25% of the exposure. With the balance 25%, the fund manager has the discretion to decide whether to be part of which of the category, or they can decide to hold in cash for waiting the right opportunity. So basically, the fund manager has the freedom to decide what to do with that the balance 25% component. So how is this managed? If you really look at, there are a couple of multi-cap funds which are already there in the market. If you look at, I've just given you the names of the funds as Fund A and Fund B because the idea is not to promote any scheme here. Fund A, if you see, large cap exposure is 33%, mid cap is 18%, whereas the cash component is 22%. Whereas Fund B, the cash component is only 2.327%. So there is, even though there is a rigid allocation of 25, 25, 25 each into large, mid, and small, there is a degree of freedom available at the fund manager level, trying to manage the portfolio dynamically. Okay, so that is where it helps you in terms of playing around with the market cycles, because generally what is understood is small cap is a cyclical performing as a category. So that's where the fund managers really help come in terms of managing the portfolio dynamically. This is where large cap as a fund would really come to our help. So to know more on this, to get a fresh perspective on multi-cap as a category, I would like to invite Mr. Anupam, and then subsequently after his side of the presentation, we would love to take as many questions as possible.
Thank you, Karthik. Yeah, thank you, Karthik. Thanks a lot. Thanks for inviting me here to discuss about our product. And good evening to all the viewers. So I will discuss. I am very happy that you actually set the stage right for discussion on multi-cap with respect to performance, etc. Would throw some more aspect on it. One of the biggest benefit of a multi-cap fund is that on one hand, it gives you opportunity to participate across market caps, and at the same time, as you mentioned earlier, is that it limits the volatility. And most of the people actually never technically understand this, that it is the volatility that hurts them more psychologically, right? And that is why they make not so sound, or they fear to make a sound investment decision. Now, the reason for fear is just volatility, because if you look at and especially the short-term volatility, because in long run, even after accounting for that volatility, the returns are pretty okay. So when we talk about multi-cap fund, and we are now in the process of NFO of this Axis multi-cap fund, there are a couple of questions that people ask. One you that started with is the whole distinction between Flexicap and multi-cap. So the most important distinction between Flexicap and multi-cap is going to be is that you will never have such high exposure of small and mid cap in Flexicap. That was the whole idea why every multi cap rather than remaining multi cap actually became Flexicap, right? Because the original category was the multi cap category, and when SEBI put those minimum restrictions, a lot of people actually concluded that they cannot achieve it, or achieving it for all the industry together in that time frame would be very, very difficult. And hence another category which was Flexicap was carved out, and they decided to remain Flexicap. So this is going to be the most important distinction, that the exposure of mid and small cap is going to be higher in the multi-cap fund as compared to a flexi-cap fund. So yes, it might be having slightly higher volatility, but at the same time, it will also have a high return potential over medium to long term. Now, coming to why one should, the next question you may ask, an investor may ask, is that why one should look at a small and mid cap segment altogether, right? Because you can be very happy investing in predominantly large cap funds, which are flexi cap funds or large cap funds, and just forget about small and mid cap because they are volatile, etc., etc. But if you look at what has happened in last 5 or 10 years or so, so this is one very important slide that I want to show. Is this is the cutoff for mid cap stock. So this is the market cap of 100th stock, and look at how it has moved over last 10 years or so, starting 9, so it's close to 11 years. In last 5 year itself, it has kind of doubled, and for small cap it is more than double, right? In 10 years it has become, for mid caps, more than 3x, and for small caps it has become more than 5x. So it tells you that this category has created immense amount of wealth in last 5-10 years. And why I'm giving you 5-10 year data is because it is important to understand that small and mid cap is really a long term game. You should not be investing in it with a short term view. So in this fund also we recommend having at least a 5 year perspective. Another aspect of it is that the under ownership of these two segments, the small cap and the mid cap, with respect to FIs, those who are the large investor who drive a lot of performance, etc. So if you look at this, the large cap ownership is almost double of what is there in mid cap and small cap. Hence, there is still a good opportunity to be an early investor in this category. One more interesting data point is that if you look at the best performing 50 stocks in last 10 years or so, across market in the BSE 500, so you will find that 5 are the large companies, 22 are mid companies, 23 are small companies. So a significant part of wealth has been created through these two categories, and hence it is very very important for anyone to have them in their portfolios. Now they can decide based on their risk appetite, etc., how much they actually want and how much they don't want, but they should have it. I strongly believe. And in next 5 to 10 year, actually, as economy grows, as purchasing power become much better and it keeps on growing, as availability of capital increases, as availability of talent increases for these smaller companies, and as we become more globalized and that benefit happens, I think small and mid cap companies are going to create more and more wealth for investor, and hence it is very important for investor to have them in their portfolios. Now the question is why you need to look at them together as a category in one product. So yes, theoretically you can have a large cap fund, you can have a mid cap fund, you can have a small cap fund. Excuse me. They are available in the market. So you can create a basket. Why you should look at them as a single cap product? That's once again very very important, because what happens is that, as we discussed earlier, you also mentioned that small caps are very very volatile, and hence at times investors ability to ride through that volatility and stay invested becomes very very difficult, right? Similarly, mid caps, they are less volatile than small caps, but they are still volatile. And secondly, also it kind of inhibits an under allocation to these categories. So when you combine them with large cap, the mid cap and small cap together with the large cap category, the volatility is controlled. And at the same time, your ability to continuously invest in these products with a disciplined manner increases, enhances. And as we all know that it is better, time in the market is better than timing the market, right? Last 5-10 year experience shows us. So that is why you should look at these three categories as one single product. Of course, if somebody is mature enough and he's capable enough to allocate properly in a disciplined manner through three different products, which is large cap, mid cap, and small cap, then this fund may not be needed for him. But I have seen most of the people are not capable of that discipline, or they are not able to follow that discipline, and hence this one single product where you get good decent exposure to all the three categories becomes very very important, right? And the last question may be that why you should do it with access. So yes, eventually everybody will have a multi-cap fund, because this is a very very important category It was just that the things got little messy because of this whole classification, etc., etc. But eventually, everybody will have a multi-cap fund. Every MC will have a multi-cap fund, and it would be a very, very important category for investors, because this category was the original category, right? It existed for, I think, the longest ever. If you look at the old best performing funds, which are like 10, 15, 20-year old, they were all kind of multi-cap funds. So they were investing across the market cap category. So why you should do it with access? Because as an AMC, we are one of the very few ones who have demonstrated track record in all these three categories, namely large cap, mid cap, and small cap. So if you look at our performance in last 5 year or 10 year or so, and in all these categories, small cap, mid cap, and large cap, we have done a pretty good job. We are very, very competitive. And hence, that track record should give you the core reason why you should look at it. Another thing is the way we construct our portfolio that you should consider while thinking about investing, etc. And you should seriously consider Access Mutual Fund as your investment partner. So we believe in growing companies, but who have a very, very good quality of management and good quality of growth. So what we look at is quantitative factors and qualitative factors. So return matrices, cash flows, profitability, low debt to equity, a strong management, transparency, and good corporate governance practices. And this is what enables us to deliver outperformance, because when we look at good quality companies, good growing companies, it helps us to avoid mistakes, that ensures a good risk management, and that results into outperformance over medium to long term, and it also ensures good risk adjusted return for our investors. And our volatility relatively is quite low as compared to other products and market, and that is because of our inherent belief in quality and growth investing. So what happens is that because we focus more on businesses which are good, which have a good track record of execution, growth, and scalability, we tend to outperform in stable and falling market, but at the same time we underperform in euphoric market conditions. But this also ensures that the volatility, delivered volatility to the investor, is quite controlled and low. So we maintain low beta portfolios, and that helps us sail through tough market conditions. So if you look at last 5 7 years, you will find a very important aspect of our performance is that volatility is quite low, and hence you can be worry free. You may not be worried about market conditions, etc., and give us time and still invest with us. So that's one very important point why you should consider access. So I think from product side, Karthik, I am done. Over to you.
Yeah. Thank you very much, sir. You kept it really simple, and it was very easy for the viewers to understand. But we have a couple of questions which we would love to
Sure.
hear from you.
Sure.
First, I'm sure it's $1 million question is, what's your view on market? And considering the market times like this, what should an investor do? Should we continue investing in equity as aggressively as ever, or is there any cautionary measures we should take? What's your take there?
So my view on market, I have two answers. Okay, one from my heart and one a very professional answer.
Okay.
Which one you want to listen first?
Probably from your heart.
Okay, so from my heart is that I am always positive about market, and I have no clue what is going to do in next 1 month, 2 months, 3 months, 6 months.
Okay, fantastic.
Right. So honestly, we have no clue, and we don't bother too much about market because we strongly believe that the underlying strength of Indian economy and its ability to grow is something that we should not be questioning. Right? And I give you a very solid example for that. If you forget heart and emotion thing, a lot of people tell us that you guys are mutual fund managers, so you guys are always positive, right? And I tell them that it's other way around. I am always positive. That's why I am a mutual fund manager.
Okay.
Otherwise, it becomes very difficult, right, to manage money if you are not optimist, if you are not positive.
True.
You just look at last 10 years, right? What happened? And starting 2011-12, we never had a very, very good time in India for last 10 years. In fact, every year was challenging, right? 11, 12, central government issues, policy paralysis, then 13 taper tantrum, and then election came, then demon came, then GST came, then NBFC crisis came, then 18, 19 slowdown, and then COVID came. Even after this, market in last 10 and 11 years delivered decent returns, right? If you look at the performance, and not just taxes, but look at just market, and I think everybody did a great job. This should tell you, and this should give you enough reason that even if after so many challenging events and situations and circumstances, and these were very difficult times, these were not easy problems. They were very, very difficult times. If we can deliver good returns, if market can give you good performance, if Indian economy can grow at a modest pace, of course the growth rate was lower than expected, then I think one should not worry at all, because this tells you that there is an underlying strength, and day by day our ability to deal with problems is going up. We are becoming better and better to handle these situations, these difficult situations, right? And these 10 years were also accompanied by very, very high interest rates and a deflationary environment. So market becomes much more predictable, easy to understand if you elongate your time horizon. So that will actually complicate, or that will eliminate the complication from your perspective in the market. However, as and when you start shortening the time horizon, you will have problem, because in short term markets are extremely volatile and we have actually no clue. No? So that's the answer. And if you ask me professionally to make a commentary on market, so of course we are cautiously optimistic, because the positivity emerges from the rapid recovery that we have seen in the economy from COVID. But of course, the new virus and high inflationary environment makes us cautious. That's a professional answer. So we expect market to be volatile.
Sure. So then, what should multi-cap approach be? I mean, where do you recommend this this category of funds to be in an investor's portfolio? Should this be part of core portfolio or satellite portfolio? What's your view, sir?
No, I think this should be part of core portfolio. You know, because what is happening is that market is broadening. As I showed you the data, that market is broadening, and it is very important for investors to have a very, very good allocation to mid and small caps. It's very important. They should not be ignoring it at all. And in next 10-20 years, as economy becomes much more broader and per capita income improves, small and mid cap companies will have great opportunity to create wealth. I call it access to Trinity. So if you look at traditionally, smaller companies, companies which are smaller in size relatively, had three major problems, which is access to talent, access to capital, and access to market. Right? So good talent never wanted in India to work in smaller companies. It wanted to work in MNCs and then in large Indian companies. Now things are changing. Talent wants to go to smaller companies. People are doing startups. People are getting ESOPs in smaller companies. And at the same time, the promoters in smaller companies are realizing that they need to change. 15 years ago, a smaller company promoter used to be a very different kind of animal. Now that doesn't exist at all. He has changed completely. He wants to change his culture. He wants to make his company more attractive to employees, etc. He wants to give ESOPs. And in last 10-15 years, large companies have created a very large talent pool who is willing to take that risk, take that plunge, get that opportunity. So they are moving. In my opinion, next 5 to 10 years, this talent thing is going to change the destiny of a small and mid cap companies, because that is the most important thing. See, we are 150 crore people in India, close to 700 crore people in the world. there is opportunity for everything. The real problem is who can execute that opportunity in a profitable manner. And that is where talent comes, right? So that's the most important thing for investor to understand. And the second thing is access to capital. I think we have completely solved that problem now, because not just Indian stock market is quite benevolent to smaller companies now. We have SME exchange now in India, which is providing capital to micro level of micro cap companies. And I'm sure after 5 years we will sell a SME exchange fund. Because I think things would be stabilized, people would be willing to take that risk. And on top of that, if you just go and ask, all the top private equity funds in the world are available in India now, and they are willing to write a check. So the risk availability of risk capital has immensely improved in India, and I don't think availability of capital is any more a problem. So any promoter with a good business plan, good competence is getting capital, whatever way he wants, right? So that's the second most important thing, that problem is getting solved. The third thing is access to market. So digitalization platform, we used to call 10 years ago, what is the moat of a large FMCG company? And we used to say distribution, correct? Because some companies are selling their products in 500,000 shops, and to reach to that distribution used to be like a 10-year affair for a smaller companies, and that is why competition used to be out of anybody. But now things are changing. With Amazon, Flipkart, you can virtually deliver 95-96% of pin code in India with just one tie-up. So that's a great thing that has happened. Similarly, globally now with China plus one strategy, we are seeing great interest from foreigners in India. The interest was there even 20 years ago, but because of our inadequate infrastructure, our inability to invest, China created huge capacities both at company level and as well as country level. So that is why they got lion's share. Now things are changing. We have a great infrastructure, and now companies are also confident, so they are investing. You see the kind of investment plan that is being made. So I'm very, very confident that next 10, 15, 20 years are going to be very great for small and mid cap companies. But the caveat here being, yes, it is going to be volatile and it will take time. So investor has to have that time horizon, and he has to be ready to have that volatility in mind and go through it. And once again, that is why a multi-cap approach is very, very suitable for it.
Yeah. No, I think that's a very interesting perspective. I think the systemic shocks and the expected what is coming in the upcoming in the future is what most of the experts are really perceiving. So hopefully, this is like 2004 to 2007 kind of a dream run. What we saw is what is in the making. Like you mentioned, hope for the best. My next question to you, Anupam, the definition of multi-cap says 25% each into large, mid, and small. So how rigid is this 25%? And is this supposed to be maintained on daily or monthly? What? How does you maintain that 25%? Do you have a little bit of leeway?
Okay. So see, the regulation, if you follow it by spirit, it expects you to maintain it on a daily basis.
Okay.
Right? And we strive to maintain it on daily basis. Every regulation we try to follow on a daily basis. Of course, there could be some minor here and there because market goes up, goes down. Suppose you are at 25.5, market suddenly falls. Some category stock falls and you go below 25. Let's say you become 24.8, something like that. So the regulation allows you to have 30 days so that you can rebalance, and within 30 days you should be well within the limit. So, but you should expect that this is a very, very rigid limit that we have to follow every day. At least as far as our interpretation is, it has to be followed on a daily basis.
Oh, okay. Unlike the equity definition, which said 65% is yearly average, that is not something. It's not an average number.
Yes.
Okay. So, but generally, with all the promises of what we've seen with small cap, but small cap also has the tag of saying being seasonal in nature. So, from Axis as a fund house, what's your view on large, mid, and small cap as categories? What's your take on that?
No, I think, see, there is no seasonality in this. What happens is that, markets are like this. They create expectations and then they create a very gloomy affair, right? Market behaves like this. But underlying economy doesn't move 10% in a month, right? Market may move 10% in a month. So the whole answer to this volatility part, especially in a small cap, is only time. There is nothing else that you can do because speculative interest goes up, people become greedy, and hence market suddenly goes up. Then you come in terms with the reality and it comes down, right? It will keep on happening. So there's no solution to it. But if you look at overall, as you asked, large cap, mid cap, and small cap, I think there is opportunity everywhere. Indian large cap companies are pretty small in global parlance of things, so one should not be worried. But yes, there is much better opportunities to create wealth in small and mid cap companies because they would always be less discovered. There will always be a risk why people may not look at them. Correct.
Okay, true.
And secondly, they will also create more mispricing as compared to a large cap. So why you make extraordinary return in stock market? Because things are mispriced, right? So in large caps, the mispricing is very, very rare because things are well understood, they are discovered well, people know about the dynamics, they are being followed for last 15, 20 years. So you know the variability. And hence mispricing is very, very limited. It happens. It's not that it doesn't happen, but it happens. But it is limited. People will just pick that mispricing very soon and act on it, right? So things will come back to normal. Whereas in a small and mid cap, the mispricing is extreme, especially in small caps, because you are not aware of about their business model. The speculative interest is very high. Greed and fear factor is pretty high in small caps, and hence ability to make money is much higher, provided you follow basic fundamentals. So I think across board there are opportunities. India is still a very, very in a nice place in terms of growth. We are just a $3 trillion economy. We have to become 10, $15 trillion economy, and one day we will become. We will achieve that number. So across the board there would be opportunity.
In fact, to pick up from where you left in terms of opportunities itself, one exciting thing is last 10 years or so, especially last 5, 6 years, the way mutual funds have grown. The size of the funds have grown phenomenally well, right? Now with multi-cap as a category coming in, and since this is going to be a part of core portfolio, I'm sure there will be larger number of people investing money. That's the general assumption we can go with. Imagine 25% allocation to mid and 25% allocation to small cap. How prevalent or how easy it is to spot opportunities? Because there are times where we have heard or where we experienced where some of the mid cap funds and small cap funds have stopped taking lump sum investments or limited SIPs only, or stopped the investments altogether because they couldn't find the opportunity.
Yes.
So, because the equity size itself growing, do you really see that many number of opportunities being there in the mid and small cap space?
See, sometimes it becomes a challenge in the small caps, yes. And it is driven by two things. One, the market levels and the underlying economic conditions. So let's say what was happening maybe in 18, 19, when economy was slowing down, but at the same time inflows were high. And other thing is that how much size you want in terms of the overall fund. Now, size depends on how the category is growing. As I have showed you in that chart, that the category itself has become 4 or 5x, last 10 years or so. And new IPOs are coming in the market. Most of them are mid and small cap companies. Very few of them are large cap companies. So yes, there happens sometime when it is challenging, but it's not a permanent structural problem. There is also ample supply and there are decent opportunities available. And in small caps sometimes you can take a cash call, and people take it. Like we took a cash call in 18, 19 that we don't have opportunities, so we will not deploy and we will wait. But in COVID we got that opportunity during that fall, so we deployed almost all the money. So I would not say it is a deal breaker or it is a very big structural problem. But yes, it's a problem that can be managed very well, especially on the small cap side. On the large cap side, I don't see any problem. Mid cap is now, it's very little. It's not that big deal.
Yeah, I mean, even I've seen it, especially 2019, Axis funds were very aggressively sitting in cash, almost double digit in some of the large size
Yes.
funds. So, how much cash are you sitting in now in some of the funds like long term equity or the other flagship funds?
No, cash is fairly limited as of now. It's like I would say ranging between 2 to 4 or 2 to 5%,
Okay.
depending on each fund. The reason why we took cash call at that point of time, so see, Karthik, we are a pure bottom up investors, right? We don't think top down. Whenever we used to meet companies, we used to get a feeling that growth is challenge. Companies are finding it challenging to grow, and that is why we were kind of not being able to deploy those money. Right now, we are not getting that feeling at all. Companies are very happy, their commentaries are positive, there is no problem in terms of demand. So cash is a residual factor for us. As long as we are finding exciting opportunities, they are growing, which are good, we will continue to deploy money. If we can't find them, then of course the remainder is the cash.
Yeah, I think that's a nice answer. Look at the opportunity, you find them, then you invest. The cash is an
Yeah,
outcome of that activity.
correct.
Definitely makes sense. Yeah. But why multi-cap as a category now, especially in market times like this? How do you think that would this category of fund would help?
No, see, we strongly believe that there is no need to time the market.
Okay.
And as I told you, look at last 10 years, right? We created decent performance. Even in last 5 years, we created decent performance. So there is no reason to believe that we cannot do it now, for next 5, 10 years. And market is, yes, it has run up pretty well, but a lot of it was also base effect, right? It fell also significantly. And if you look at last 1 year or so, profitability has also gone up significantly. So when market has gone up, it's not just on the hope, but it is also driven by some basic improvement in earnings. And now we have to see how earnings pan out, growth pans out. But we are pretty confident. So that is why we think that it's a very appropriate time for us to launch a multi-cap fund.
Okay. So, Anupam, when it comes to the matter of understanding large cap funds, mid cap funds, or small cap sectoral, there is no ambiguity. But when it comes to the matter of the so-called all-season fund, that is earlier erstwhile diversified equity fund, subsequently we named it as multi-cap, now then Flexicap. So then, what is the primary difference between Flexicap and multi-cap as a category? Can we have both the funds in the portfolio, or would you recommend either of the one in the portfolio?
No, I think both can be had in portfolio. So see, there are two differences from an investor perspective. One, the time duration. The money that you can park only for, let's say, 3 to 5 years, I would suggest a flexi cap. And if you have a time horizon of more than 5 years, I would suggest a multi cap. That's one very, very important difference because flexi cap are more large cap oriented. For example, in our flexi cap, we promise minimum 50% large caps, right? So that you can have a lower time horizon, whereas multi caps are higher small cap and mid caps. So we would urge you to have a longer term time horizon. And second thing is that in multi cap, you have to have slightly more appetite for volatility. So maybe in flexi cap you cannot see -15, -20. In certain cases, in a multi cap, you may have to see those kind of volatility.
Okay, sure. So from that point of view, can we say the return expectation should be slightly lower for flexi-cap as a category, and then we can have a slightly higher return expectation from multi-cap? Can we say that?
Yeah, that should be justified. Yes.
Yeah, because we are taking slightly higher risk, we
Yes.
should be rewarded with slightly higher returns,
Correct.
provided
Correct.
it is held for, like you rightly mentioned, a longer period that is beyond
Long.
5.
Yes.
So we are seeing host of Nfos with respect to multi-cap as a category. I'm sure you did mention that as well. So what's your take here? Should we be looking at any of the existing multi-cap funds or Nfos? You think that will make a big difference here?
I don't think so. If we launch a very, very different product, with a new thought process, new philosophy, new theme, then you may question that, okay, whether you have capability to deliver on this or not. But when we launching multi-cap, basically it is composite of large, mid, and small cap. So we have a demonstrated track record of managing and performing well in all these three categories. So so why you look at existing fund, because it has a track record, right? There is no other difference. Otherwise, whether you buy in NFO or you invest in existing fund, your journey starts in a very similar fashion. So from that perspective, I think you can even look at this NFO because we have a good track record.
Sure. Yeah, I think from that way, Axis has, like you rightly mentioned, has delivered not just in good times, even when markets were not doing so well. I think Axis really stood out in terms of the performance. That really makes a lot of sense. Then coming back to the primary or conceptual understanding itself, how different this fund is from a dynamic asset allocation as a category of a fund versus a multi-cap fund?
Oh, it's going to be dramatically different. Because see, dynamic asset allocation products are essentially products to give you very, very low volatility, right? Because they are conservative in their approach. As market is going up, they are reducing equity, and as market is going down, they are increasing equity. So essentially, they are targeting a very, very low level of volatility as compared to any other product. You know, so this is at other spectrum of the volatility. Here you are going to see high volatility. You would always remain invested, and at the same time you will have exposure to higher volatility segment of the market, which is small cap and mid cap. Generally, I have seen most of the dynamic or balance advantage funds are predominantly large cap funds, because the investor in that product doesn't want the best return. At least for us, we clearly tell that Axis Balance Advantage Fund is not the best return product. It is the best risk control product, that you can participate in equity, have the some upside of the equity, but at the same time, you may have extremely low volatility when it comes as compared to, let's say, market, overall market. So they're at just the opposite end of the spectrum.
Sure. Yeah, I think makes sense. That gives us the best of both the worlds, equity and debt. Multi-cap gives us then access to best of within the equity, all three worlds. That definitely makes sense. But what could be some of the downside one should keep in mind before investing into multi-cap as a category, if you were to pick, or if there are any, if accordingly?
Yeah, so I think just because it is multi-cap, you should not expect that you can become rich very quickly, or you can create very fast return very quickly. So time is very important. That's the biggest downside. Market asks you only for time. It doesn't ask you anything else, right? So you have to give it to him. And other thing is that it will have volatility. It's not a very low volatile product. It is going to have volatility. So you need to bear it. You need to have that appetite. So if your portfolio or if your investment in this product is -10, -12, you should be okay with it. If you cannot be okay with it, if it is going to impact you, and in terms of your money investment planning, financial planning, make a serious impact, then I think you should not consider this product.
Sure. So since you're here and then you're expert on equity markets, would love to pick your brain on some of the market-related aspects as well, if you're
Sure.
The general investment 101 tells us that whenever an inflation is going up, interest rates would generally, the central banks would take steps towards increasing interest rates. So as the interest rate starts going up, liquidity will start drying. I think US, the inflation rates have, I think, is one of the highest in the recent past. Does it mean that liquidity is going to go down? Should we start worrying about tapering impact?
I think tapering has already kind of started, right? So liquidity infusion is getting slower and slower, and at some point of time, there would be liquidity withdrawal. But one important thing that one has to keep in mind is that everybody knows and understands that it cannot be a lost cause. Correct. So whatever central banks have done, whatever governments have done, they cannot simply undo it at the cost of economy. So yes, there would be sentimental impact. There would be some impact on the market because from somewhere excess liquidity has come into the market that will adjust itself, and that will happen. I'm not denying that because we believe there is liquidity which has got into the market and driven it up. So that will go away. That will have its impact on the market, but that is all short term events, right? Medium to long term, it is the earning growth that drives the market and the stock prices. So one should focus on that, and it is eventually it will happen. What you are saying is correct. Rates will go up, rates have bottomed out, and liquidity will go away. But if it is accompanied by a decent amount of growth, I think both can be balanced pretty in a very easy and a better manner for investors.
So yeah, then in that case, any foreseeable timeline you see in say in next 1 or 2 3 quarters, liquidity is expected to go down. Any timeline would you have in mind?
Sorry, Karthik, I have no view on that, not an expert on that. So you need to talk to my debt guys because we are pure bottom up, as I told you. So we are so much focused on at micro level in companies, what they are doing, what they are not doing, what is driving their demand, etc. That we generally don't focus too much on all these complications.
So you mentioned one very interesting point. Your as access as a philosophy is bottom up. That means you look at companies and understand. Markets like this, isn't it difficult to find value companies or value buys? Generally, how easy or difficult it is to find such good quality companies at the right valuation?
So it depends on how you define value, right? If you still define value at 5p, 10p, then yes, you will not find them. But you know what differentiate or what differentiation we can make over there is that if the horizon of growth is much longer, and if we are able to decipher that as compared to any other investor who may not have thought beyond 2 3 years, right? I think there we make the difference in terms of understanding those companies. And I can't name companies here, but you know, one of the companies that we bought 10 years ago, and we continued to hold it. Most of the time, it used to be called a very, very expensive stock. From a small cap, actually, it became large cap in 10, 11, 20, 10, 11 years. Okay. So, what was there? It was our ability to understand and decipher the capability in the company, the competence that it had, the way it was approaching business opportunity, and the overall size of the opportunity. Right. So, essentially, what we do, if I explain you how we decipher this problem. So, when you are buying a stock, you are taking four risks, right? Promoter risk, business cycle risk, and valuation risk. Right? Eventually, everything comes down to these four things. So, what we have decided is that we will never take promoter risk and business risk. Now, what is promoter risk? There are two elements to promoter risk. One, you can buy an incompetent promoter or management who is basically not capable of delivering or growing or creating a very scalable business model, because as an entrepreneur you need to show a lot of capabilities, different kind of capabilities, to give us confidence that yes, I can deliver it. We never take that risk. So we are never going to buy an incompetent, incapable promoter. So we work very hard on the capability side, because eventually it is the capability that will drive growth, right? So as we say, when you hire an individual, you look for capability and confidence. The same thing happens with the company, right? You look at capability and look at confidence. The second part of promoter risk is basically the corporate governance aspect. He might be a good guy, very capable guy, but at the same time, he may not be that investor friendly. And even then, you are not going to make money. So we also never take that risk. So in nutshell, we never take promoter risk. We never take business risk. So we'll never buy bad business. And we have a very clearly thought out definition of what is a good business for us, what is a bad business for us. At least this is, and it's not a universal definition. This is our definition based on our understanding, our research that, okay, for us, this is a good business and this is a bad business. and we will never buy a bad business. Third is the business cycle risk, that you might enter into a company, invest in it, and the cycle may go wrong. So, yes, inherently we cannot eliminate that risk because we are humans, we make some mistakes. But most of the time, the depth we have in our research, the team, its strength, we have made very, very less number of these mistakes where we have gone wrong in forecasting the business cycle. And we generally take a very long term view, we don't take a short term view, right? So we adjust accordingly in terms of valuation, etc. And then fourth comes is the valuation risk. So if everything is fine, we get a great guy, competent, very good, investor friendly, a very good business which has a good scalable potential, and we are entering into a favorable business cycle, we are willing to take a little bit of valuation risk, right? Now if somebody calls it is not value, we say it is an extremely valuable thing, and that is how we look at it. So we want to be investor for a long period of time, 5-10 years, and generally we have seen that good companies create extremely good amount of wealth in those time frames.
Yeah, no, definitely makes sense. So valuation itself is not the top of the shelf parameter you would look at. So according to you, then it's probably one of the last parameter you would look at if all other conditions are satisfied.
It is a very important parameter. It's not that we don't look at it, but out of these four, relatively it is less important.
Yeah.
The first three are more important.
More.
I would put it like that.
And last 1.5 year phenomenon has been that there's a larger number of people who come into equity markets. There's a greater degree of confidence in terms of making money by investing into stocks directly. With no disrespect to you as a fund manager, the question is, what is the value add from the fund manager because of which where people should have higher allocation to mutual funds compared to direct equity? What's your take there?
No, you are absolutely right. And it is not a question of disrespect. See, if somebody can invest on his own, why he need to outsource, right?
Yeah. Okay.
We exist for those people who cannot invest on their own, or if they think they are not capable of that. So if somebody is capable of managing his own money, investing in market, I think we are absolutely useless for him. We are only useful for those people who cannot analyze balance sheet, who cannot analyze complexity of businesses, who cannot predict project business cycles. For them, we are useful. If somebody wants to invest,
The reason why I'm asking this question is, as a retail investor sitting at my desk, all I have is my computer and access to a couple of websites where I could go and see the financial statements. I think beyond that, I don't think you would have too much of information or the liberty to really dig deeper into, like you mentioned, looking at the quality of the promoter and So likewise, what would be some of those elements where you have an edge over retail investors?
sometimes we misconstrue data as wisdom, right?
Okay.
And there is something called experience. So we are seeing companies for last 15-20 years. We have a certain way of analyzing competence. So I think looking at data, yes, it is a very important factor. We also start with data, but then there are a lot of qualitative aspect that we have to get into, right? So let's say if you are buying a chemical company and company is making 5-10 products, how you understand what kind of opportunity is there, what kind of competence this company has, and that is why a lot of people have gone wrong, right? Because they just looked at data. So that's what I'm saying. It requires certain amount of training, skill set, and still we make mistakes, right? It's not that mutual fund managers don't make mistakes; they make 100% perfect investment decisions. So even after with all this data, information, experience, teamwork, we go wrong, But still, I would say that for a normal retail investor, of course, bull market makes them better than fund managers on paper. Yes, they get a very good delivered return, and I agree to that because we are driven by certain risk management practices, etc. So fully appreciate that. And in last couple of bull market that I have seen many people who have delivered better than us during those 6 months or during those 10 months. But if you are not confident enough that you can manage this, understand this for next 5-10 years, then I think mutual funds are a good place for you. But if you are confident that yes, I can continue to deliver like this for next 5-10 years, then all the best. I think world is waiting for you to become rich.
Yeah, I think that's a very unbiased view. You didn't go back with saying that no mutual funds are the answers for everything. But yeah, thank you for that. So thanks for giving us your time, and your session was really insightful. Got a very interesting perspective on multi-cap as a category, because even though we did talk about a lot of fundamentals, it's always good to revisit basics once in a while, and then try to keep the overall portfolio management concept itself as simple as possible. So thank you very
Thank you,
much.
Karthik.
Yeah. I
Thank
wish
you,
all of you.
Karthik. Thanks a lot.
I wish all of you a great weekend. Thanks for joining. Thank you.
Thank you. Bye. Thank you.
Thanks. Bye.